Tonight, we're just trying to figure out what are we going to do with taxes this year. We don't really know what's going on as far as some of the tax plans. We don't know if they're going to be implemented this year or next year or what have you. And so at some point here, we're going to have to figure out, all right, this is going to be our tax plan for 2025 and 2026. And that's going to be a little harder than I thought it would be probably a few months ago because I haven't really heard anything coming out of Washington yet as far as where they want to go with the taxes. And we're coming up here on, probably our one of our least favorite days of the year, our Tax Freedom Day, and that's just the day after tax day. So tax day is on a Tuesday this year, so our returns are due on April 15th. But the very following day is the day that the average American is finished paying taxes. So all the days that you've worked in January and February and half of March right now, and then add the rest of March and add the first half of April, that's the amount of time that you'd have to be working to pay your tax bill for this year. And so April 17th is the day that you start earning money for yourself and your family. So the question always becomes then, what can we do about this? What are some of our options as far as the taxes go? Um, and, if we go back to 2024, I mean, is there realistically anything we can do retroactively? Well, not too much, right? We're not going to get into a situation where, we're going to backdate documents to December, do something silly like that. What we're looking at here is a few retroactive tax planning moves that you can make right now. Contributing to an IRA, if you haven't done that for 2024, you can do that up to April 15th. And again, the amounts over here are going to stay the same for this year. So if you haven't made an IRA contribution for last year and you want to do it, whether it's a Roth or a traditional one, and whether you get a deduction or not, you could put in the 7 grand, and if you're over age 50, you can go up to 8 grand here, put that in for last year, and then also put in another 8 grand for this year, assuming you have some sort of earned income. Now, the big thing here with the SEP plans, and these are like 401ks, so a lot of small businesses, the benefits to a 401k and a SEP are pretty similar. Depending on what you want to do with some of the investments and also some of the limitations with loans and what have you, one of the plans may be better for you than the other plan. But the SEP plan allows us to go to the due date, including extensions. So if I have a SEP plan and I have it set up under my business, okay, which I need to do for any of these retirement plans, I can contribute then up to a maximum of $69,000. So I can have, and certainly did this quite a bit when I was had my law firm preparing taxes and doing a lot of planning. But I would get into these situations where say, look, I've done a quick draft of your 2024 return, and it looks like you're going to owe about 20 grand. But if you can contribute 50,000 to a SEP plan, I can eliminate your tax bill. And people will start thinking about, well, do I want to pay the government? And if so, how much? Because you can control to a certain extent here with a SEP contribution or perhaps a 401k contribution, as the next slide is going to show us that, yeah, you can go ahead and contribute to that, but the 401k plan does not include extensions. And so whatever the due date of the return is, that's when it's going to have to be done in order to be able to use these plans for last year. Now, you can get into being able to use them again for next year as well. All right, I want to take a look then. I'm not sure how to get rid of all my scribbles here. This is going to bother me until I do it. Um, oh, well, there's got to be a way here. Let me see here for a second. Yeah, it's not letting me erase them. Oh, well, I'm going to stop scribbling then if that's what's going to happen here on it. Pretty ugly slides, though, that's for sure. Anyways, I want us to take a look at some of the differences between 2024 and 2025 and some of the changes that are going about. And you can see in this final column on the far right side that the changes are not that big. So whatever you were doing in 2024, you can pretty well do it in 2025. Just take a look and see kind of where we're at as far as the numbers go. So yes, maybe last year you could put 23,000 into a 401k and your employer could make an additional contribution of double that, so you could get up to 69,000, and that's gone up to 70,000. But we really haven't changed any strategies here, and I think that's the really big thing is that there's nothing that we're doing that is going to change any of the strategies for this particular year. Where it really comes into play is going to be in next year. And the reason I say that is that when we get into this presentation tonight for a few more minutes, a few other things I want to talk about before we get into some of the planning. Just like we had last year, the cryptocurrencies, if you're exchanging, buying, selling, otherwise disposing of them, anything, any amount, there's no minimum here. We need to disclose that to the government. And I think they're going to be looking at this with greater frequency. I suppose if there's anybody at the IRS to do audits after the number of people that are getting laid off or terminated there. But the bottom line here is, again, we need to disclose this to the IRS. And the crypto stuff can be a little confusing because in some instances, we may buy these as an investment. And so every year, going back to at least June 1 of 2021, so I'm going back a few years now, I've used this as a starting point. And last year when I did this, we had a really tiny capital gain. So if we went back to March 1st of 2023, I think this number was around 38,000 or something. Well, it's jumped up quite a bit. So if we would have sold it on March 1st, we've got this $25,168 long-term capital gain that we've got to pay tax on. So if you're dealing in any of the cryptocurrencies, it's treated just the same as if you were buying a stock or some other asset that could be a capital gain. Now, looking at this example 4 here that I have up here, so again, let's assume that I get this crypto back on June 1st of 2021 for 37 grand. So let's say that was whatever, some sort of a contract that I received this in lieu of US dollars. Option one here as a business owner would be fine, just liquidate the Bitcoin into US dollars at the end of the day, get my 37,294, and I just report that as gross receipts, just like any other cash or credit card or any other transaction. Option two would say, hey, I want to keep the Bitcoin. So I would still report the 37,294 as gross income that year. And then I would report the capital gain whenever I converted it to US dollars. Okay, so maybe that's a gain, maybe that's a loss. As the last slide just showed, it would have been a real nice gain here over the last 3 years. So we need to be aware of that. But I want to really look for what can we do this year. We can say, well, okay, yeah, maybe I can throw some money into a SEP or a 401k or a retirement plan or contribute to an HSA because I really like that triple tax benefits of the health savings account, where I get a deduction up front. I don't pay tax on the investment earnings, and then I don't pay tax when I take it out as long as I'm using it for qualified medical expenses. So it's a triple tax benefit on the HSAs, but otherwise, right now, we've got to be looking at 2025 and 2026. And I know that sounds kind of preposterous, thinking about, we've just barely started 2025. Um, but we do need to be cognizant and aware of what are we going to do as far as our personal tax planning. So before I get into what some of the provisions that are going to be expiring, I want you to think about yourself and your personal situation And what type of taxpayer are you? And these hats over here, looking at this, we can look at it as different buckets for expenses or income or whatever. Flip it over, we've got our hats. We can wear several of these hats because, yes, I still get a W 2 from one of my businesses. And yes, I do have K1s from flow through entities. And yes, I do have a C Corp. And I do invest in real estate. And I do invest in the stock market. So, yes, I could be wearing several of these hats, but depending on which hat you wear is going to have a real big impact on what you're going to be doing with your tax planning for the next 9 months and then going into next year. And the reason that I focus on this year to year thing, so if you would have been listening to this a year ago, or, I think Don said we've been doing this 15 or 20 years. I think that's probably on the low side. I think it's been probably at least 20 years been mentioning this, I'm sure in each one of these last minute tax tips is we need to consider the years and to be able to split the years up. And that maybe we want to take all of our income in one year and all of our expenses in a different year, or reverse that, or try to put them all together where our income and expenses all match in the same year. So we're all different and we've all got unique tax situations. And so, on this call tonight here, there's several hundred of you listening. There'll be several hundred of you listening in the next month or so as you're replaying it. Or if I was doing this at, one of Don's events in the past where we had big conference rooms full of 600 people, I'd say we have 500 or 600 different tax situations because everybody is unique. And so don't worry about what other people are doing. Let's think about what you need to be doing for yourself. And when the first Trump tax cuts went into play, they were passed right at the very end of 2018, went into effect, and everybody was saying, we don't really need to worry about it. They expire so far in the future that whatever, we'll deal with it, sometime then. Well, guess what? The future is now. And so, what's going to happen with these provisions is going to make a huge difference in who you are as a taxpayer. Which hat are you wearing? Do you have real estate? Are you a stock market investor? Are you a professional? Are you a trader? What sort of status do you have with respect to your businesses or investments or other sources or buckets of income? It's going to make a big difference on these provisions that are expiring. So, beginning in 2026, we know that if these are not extended, as of January 1 of 2026, our top tax bracket goes from 37 to 39.6. So if you happen to be that person that's in the top tax brackets all the time, right? You're making seven, eight, 900,000, seven figures, whatever, and this still is unresolved at the end of the year. In my opinion, is that we're going to get a tax bill. I don't know when, and I don't know exactly what it's going to say. But if we don't get it, we're going to be looking at trying to move income from 2026 into 2025, right? So that we can take it at the top bracket of 37% and save 2.9% on tax. The reduction in the standard deduction here, and so this 15,450 number is for singles. And so married, you're almost at 31,000 this year, will be cut in half pretty much. So we say, okay, that's a bad thing. So we've got two bad things here, but our personal exemptions return. Okay, so that's a good thing in that we would get $5,300 for each person in the family. So myself and my spouse, we would get $10,600, which would make up for the reduction in the standard deduction here. So if we don't itemize, lots of different things come into play. Child tax credit goes down, bad thing. Moving expenses deductible, okay, good thing. So I think you can kind of see that depending who you are, charitable donation deduction goes down. So perhaps we want to accelerate our charitable donations into 2026 if we're still talking about this and it's now into football season again and we're getting ready for Thanksgiving, right? I mean, if it's a situation where we still don't know what the tax laws are, then we better start thinking about there's a real good chance that these slides that I'm showing you today are going to become the reality and not just, well, they'll get something done in the next 9 months. Um, I'm not counting on that, although again, I certainly think that's going to happen, but I think anything's possible these days, right? $10,000 SALT cap is eliminated. This would be a good news for most of the tax returns that I see. The SALT stands for state and local taxes. And so right now, if you have local income taxes, local real estate taxes, property taxes, what have you, the maximum you can take is 10,000. Well, for somebody in Colorado, we hit $10,000 of income taxes at a couple 100,000 of income. And so we lose a lot of deductions in Colorado, and we're not even in a real high tax state, right? And so I don't even need to get to the big players on the East and West Coast where people are losing tens of thousands of dollars of deductions as itemized deductions. Home equity interest again becomes deductible, so that's a good thing. Theft casualty losses become deductible again. Good thing if you have that bad thing happen. But high income taxpayers, and probably should have put that in quotes, you may see your deductions reduced again because we start having limitations. So a lot of this stuff goes both ways where it's like, yeah, that's a good thing or that's a bad thing. But I was reading just a couple days ago where about 62% of all individual taxpayers would see a tax increase if all of these provisions are not extended. So if Congress just does nothing, or they can't get a bill through, right, where there's just gridlock and nothing happens, that 62% of us would see a tax increase, 38% presumably would see a tax decrease. So doesn't look too good for the country as a whole. Also puts into play or causes to start looking at a lot of other things because our estate tax exclusion, which is now up to right at $14 million a person. So a married couple can exclude up to right around $28 million, just a little bit less than that, of assets with a proper estate plan now. And considering that most of us on this particular call, myself included, do not have estates of $28 million or more, we don't have to really worry about estate taxes, right? If I would die this year, I know that there would be no estate tax due for my family. I couldn't say the same thing if the estate tax exclusion amount is not extended. So we would get some inflation adjusted amount to about half of what we have today. Makes a big difference in how we want to use gifting strategies, how we want to use estate planning. A lot of different changes come into play. And some of these that I was talking about are not even the biggest ones. I think some of the biggest ones are on this slide right here because it eliminates qualified business income. So this section 199A guy over here on the right side came about as a result of the Trump tax cuts. So before the Trump tax cuts came about, we didn't have Section 199A. If you would have asked me in 2000, 2015, 1998 or something, what's Section 199A, I wouldn't know. But now I know. And that's the 20% or maximum 20%. But for most of the pass-through S corps and partnerships, LLCs, what have you, basically anything beside a C corp, we're getting at least some of that income reduced. So maybe it's not 20% for you because your income is quote unquote higher than the average, business income or whatever, but you're getting some reduction, and that's going to go away along with bonus depreciation. It would bring back the fact that we could take any of the losses that we would have. So this section bullet, second, excuse me, second bullet point here when it says no NOL, that's net operating loss. And so now there's an 80% limitation, so you can't use all of the losses at the same time, and that would go away. So again, a small gain for two really big bullet points that we would lose. Now, some of the things that were passed back in 2000 and what was it, 2018, I guess, are not going away. So these are permanent provisions that in 2025 and 2026 are going to stay the same, unless, I guess, unless Congress would change them, which is always possible. I don't see any of these changing. So C corporation rate, that one was in the 30 some percent. It's going to stay at 21. Entertainment expenses still eliminated. 1031 exchanges still restricted to real estate investment. So before we could use them with personal property, we saw a lot with business automobiles, and so we have to do a little bit more funky calculations, but in general, not a big deal. Roth conversion recharacterization, so we can't, make a contribution to a Roth and then change our mind halfway through it. That was eliminated. And then, as I mentioned, this NOL limitation would come back into play. So these are all permanent provisions here, but I think we have to be watching this really carefully and perhaps not right now. But if it turns out that some of these provisions are going to go away, because the Republican Party right now has a very, very small majority in the House and the Senate to get any of these bills through. So they're going to have to pass them either with help or with nobody from their party straying, right? And so they're going to have to be, everybody's going to have to stay together. And I don't know to what extent that can be done or will be done. So that's what I'm going to be watching is as we get closer to the end of the year, do we have a new tax strategy in place because we have now had some light shed on all these provisions that are expiring. So that's something that I think all of us need to watch. And your tax advisor, whoever that may be, and you need to have one if you don't, but whoever that tax person is for you, or the way that you're going to be getting your tax knowledge, make sure you stay up to speed. So I know Don mentioned before that, he puts on or they put on these webinars pretty much weekly, but did mention the 3-day event. And my friend and colleague Toby Mathis, I believe, is speaking at that, and he will be talking about some of the things I'm talking about tonight, but going into more detail about some of the planning that you can do right now. So when I think about planning, I want to first talk about tax brackets and sort of the misnomers of, oh, if my income gets too high here, I'm going to kick myself into another tax bracket. That can be true, but we all pay the same amount of tax on the first small amount of income. In this case, it's this 11,600, 47 grand, and then this 58 grand. And there would be another column over here for married couples that filed joint, kind of like this pyramid looks. And this is the way I like to look at the tax brackets. So myself, and I'll just take somebody that is making a whole lot of money here. One of my favorite NBA players, Nikola Jokic, or who us Denver players or fans call the Joker. He makes about 52 million, I believe, per year. So me and the Joker, me and Nikola both pay the same amount of tax on the first 11,600 of income. And since we're both married and I don't have him as a client or do his taxes, but I know he's married. I'll assume he files jointly. He also only pays 10% on the first 23 grand. And then it kicks us both into the 12 and then the next amount. And so once we go over 94,000, that means anything between 94,000 and 201 is taxed at 22%. And once we get over that, it kicks us into the 24 and the 32 and the 35. Notice between the 35 and down on our pyramid that the married filing joint is double the single amount until we get the marriage penalty at the top. So there's a lot of situations where we have two really high earners. Say we have two single taxpayers that are each making 800,000, and we say, should you get married? And the answer is no, no, you shouldn't, because you're going to be paying tax at, the little bit over 800,000, 800,000 to 600,000 at 37%, where here it's going to be a lot more if we combine the income. So we always want to be looking at the different brackets and where does that put us on the investments and our business income. Because maybe if that jumps us up between, up from 32 to 35, we know now that any expenses we come up with, whether they be business or maybe rental property or whatever, are now going to be worth 35% to us. And so when I talk about maybe bunching your income and expenses, maybe this year is going to be a really bad year for us overall. So I'm only going to make, 50,000 and I'm single. So I'm going to be just barely in this 22% bracket. But next year I know my income is going to be way up here. So I may want to hold back some of these expenses so that I don't get them at 22%, but hold them back to next year where I get them at 35 or 37 or maybe 39.6 if Congress can't get its act together. So all of these are considerations that we have to look at in addition to some of the tax changes that come into play. So, yeah, our Social Security wage base, meaning how much of the employment taxes, or for those who file a Schedule C, the self-employment taxes, how much do you got to pay on? Last year it was 168. It goes up about 8 grand. So that's the amount that the 15.3% employment tax gets hit on. Our standard deduction, if we don't itemize on Schedule A, is 15,000 for the single taxpayers and then doubled for the married filing joint. You always have the option, though, and keep this in mind for any married taxpayers, that you can file separately or jointly in any year that you were married as of December 31st. Okay, so it doesn't mean that if you file married filing separately, it doesn't mean that you're going through a divorce or you're actually separated or you're not living together or anything else. It's something that whoever is doing your taxes should prepare a calculation and say, this is what your tax bill would be if you go married separate and married joint. And for the vast majority of married couples, married filing joint is going to give you a better tax result. But there's some instances where, depending on the investments or the income and the disparities between the spouses, where married filing separate may be the way to go. And it may certainly be the way to go if you are in a situation where you may be getting divorced or you don't trust your spouse or you think there may be tax fraud or something else. But in general, you can switch back and forth and doesn't raise any red flags. If you got hit with the alternative minimum tax, I just wanted to put on here, and you can look at these slides certainly later as to the exemption amounts, and they go up a little bit every year. But what are you going to do here? It's like there's very little you can do as far as the planning goes for the alternative and minimum tax. If it's something that you get hit with every year and you're going to get hit with it again this year, certainly talk to your tax professional about planning. Is there anything I can do to eliminate that tax? Because the tax hits at a pretty high rate. It's in the high 20s. So I want to say it's 26 and 28%. I may be a little bit off on that one, but the bottom line is it's still a tax that if we can avoid, let's avoid it. Health savings account, that's our triple tax benefits. I mentioned that before. Let's do it for sure. And then the earned income tax credit. This one went up a couple $100 this year. So that's if something you typically qualify for, you may want to be looking at it again for 2025. Any other changes here this year? Right here, $19,000 for the gifts, up $1,000 from last year. You cannot retroactive gifts as of right now. Okay, so that's a question that I typically get when I do this presentation. Can I write a check out for 18 or 19,000, whatever it is? So 18 last year in December and say that just wasn't deposited No, let's not get into that. Let's, start with a possible gift of 19,000 for this year. The reason I like the gifting so much um, is that one, we don't know what the federal estate tax is going to be in the year that we pass away. So we can say that yes, if we happen to die in 2025, this 13.99 million number that's down here on the bottom, that could come into play again, certainly. But if we don't know, what's the exclusion rate in 2029 or 2043, or pick some year in the future, who knows? So this gets $19,000 out of our estate for estate tax purposes. It also gets the income on this 19,000. So let's say we invested and it makes a couple thousand bucks. That gets us into somebody else's tax bracket. So this is normally a grandparent to a grandchild, a grandparent to kid, type of thing, or maybe the child to their kid or the grandchild in this case. So a lot of different possibilities as far as the gift tax goes, and the gifting, but it's part of the exclusion amounts that you need to be aware of. So in this particular instance, for this year in 2025, my wife and I could give each of our kids $38,000. So I could give each of them 19 and she could give each of them 19. And we do not file a gift tax return. We just put gift on the check and send it over or put it over on a wire transfer or a bank transfer, however you want to do it. But just note that it was a gift at that point. Now you can give more than that. So if I wanted to give $20,000 to each of them, I would have to file a gift tax return, wouldn't owe any tax, but I would have to file it as the person making the gift. So the extra $1,000 to each of them, I'd have to report that to the IRS, which obviously we don't typically want to do. Other things that we can take a look at here: 401k changes, again, 2025, I mentioned that those go up a little bit, $500 and $1,000 overall, the $70,000 down here. And so that's something that I encourage everybody to at least look at. You don't have to put in the maximum. So when I say 70,000 for this year, if your business can only afford to put a couple thousand in, put a couple thousand in. I don't care what it is. You can go up to 70K. And if you start looking at things where you want to have a higher plan than that, then you want to be looking at some of the defined benefit plans instead of these defined contribution plans like I'm going to talk about tonight. So you can look more at the pension plans, and the cash money plans than these 401ks or SEPs, or for the public employees, the 403B, 457 plans. So these catch-up provisions are going to stay the same for purposes of these plans. But again, if you can't do the full 70, put in what you can. Anything really is better than nothing at all. The Secure Act still comes into play for taxpayers that are in this sort of a vulnerable period, according to the government, and that's those who are, in this 60 to 63. They're getting ready to retire, but not quite there yet. A couple more years to go. So it allows additional contributions. Same thing with these Roth IRAs down here. So if you're in this situation where your income is under these amounts, this 150 or the 236 if you're married, you may be able to do the Roth IRAs. So again, if you don't, if you can't do the Roth, put into the traditional, or whether you can deduct it or not, at least get it earning tax deferred income, right? I mean, that's like all of our IRAs are going to do that. The Roth is a real pretty one, obviously, because we have the opportunity to never pay taxes again on that money because we've already paid the taxes. So while, yes, I love the Roth IRA, I realize it's not for everybody. A lot of people don't qualify for it or may want the current tax deduction. All right, a couple more things I want to mention here this evening before we get to any of the Q&As. Make sure that you claim all tax deductions that are available. I don't like holding any tax deductions back. If you want to claim the home office, that's fine. Go ahead and claim it. It's not going to get you audited. We talk about accountable plans, and now I think that's a lot better way to go about the home office. But whatever, home office is fine. If you're having any points with your home mortgage, this can be on your particular mortgage. It also applies to rental properties. So not only your personal residence, but it can apply to rental properties. I've also seen people miss tax credits over and over again and tuition and fees expenses with college. The tax credits, though, I really hate to see because unlike some of these, home office, that's a deduction, points deduction, expenses deduction, all of these are deductions, which are fine, but our credits are the guys that reduce our tax liability dollar for dollar. So it's not just 35% or 30 or whatever tax bracket we're in, but if you owe $5 and you get a $5 tax credit, you don't pay anything in tax. And there's a lot of credits that are available at any given time. So, right now there's talk, at least on Wall Street, that we could be sliding into a recession. And if that happens, what the government does a lot of times in recessions is tries to bump the economy with tax credits or with additional deductions. So again, not only on these expiring provisions that I've talked about, do we need to be really cognizant about, but also some of these changes. What kind of credits are going to come about this year? I don't know. I don't know what's going to happen in the next 9 months. Other things I see missed over and over again, rental property deductions. You don't know what you can deduct, or you're not taking your automobile mileage. You don't have a record of it. It's not worth keeping the records. I mean, I've heard all the excuses. Don't do it. Claim every single tax deduction that you can claim, right? Whether it's a rental property, whether it's a business, whether your business is taxed as a partnership, an LLC, an S Corp, a C Corp, a sole proprietorship, limited partnership. I don't care what kind of animal you have for your business, how it's set up, what kind of entity structure you have. Never, ever leave expenses on the table. Okay. Retirement plans as well, really nice way. I think by now, I hope that the 5 or 10 minutes I spent before on the retirement plans at least took you into thinking about how we can use retirement plans not only for reductions today, right? To be able to reduce our tax liability this year, but also get that big tax deferral. Or if it's a Roth plan, to get that complete tax-free income for everything that that particular investment earns in the future. And think about it, if you're 20 years old, you've got 45 years till you're ever going to touch this, right? Till you're 65 and you're going to touch this Roth account. Over 45 years, how many times is that going to double? And what kind of amount of money are you going to have at the end of 45 years with never paying taxes again after you make the contribution? So I think that's just it's critical that if you can get yourself into a Roth situation from a Roth 401k or a Roth IRA or whatever, definitely take advantage of it. Look at it. It may not be right for you. Again, you may want the current deduction, but it's something that all of us need to be looking at. I also like income shifting strategies. So I've mentioned the gifting, where we can gift up to 19,000 this year. We can gift appreciated assets, and it also gives us an income shifting opportunity. So what if we gift maybe a percentage of stock in a business that we own, or a membership interest in an LLC or whatever? We can certainly do that, and then hopefully when that goes up, the taxes will go on to the person that's paying less in tax, typically our kids, right? On that. If we gift appreciated assets, be aware of this rule though, that, and this is kind of a major consideration. The person that receives the gift, the donee, uses the donor's basis. And this is completely different than an inheritance. And it's really, really important that you understand the difference here. That If I buy Microsoft stock for 10 grand, and let's say it's worth $50,000, and I want to give it to my daughter, I can do that. But it's not going to come under 19 grand because the value of the gift is going to be $50,000. And so when my daughter receives it, she's going to get the stock at my basis, sells it at whatever the fair market value is, and will pay tax on the capital gains. So be aware that when it's an appreciated asset like that, it's going to have consequences for the person who received the gift. And it may not be a bad thing, but a lot of people are not really aware of that. It may be better to gift cash and then wait for an inheritance situation before the person receives the stock, because in that case, they would get a step up in basis. The other thing I want you to be aware of here with gifting is that there's this kiddie tax provision. And what does that mean? Well, it means that once the investment income on your child, here that's a minor child, so we're under 18, or maybe a dependent, going to college or what have you, but once their investment income, so that could be capital gains, that could be dividends, interest, what have you, goes over 2,700, the rest of it gets taxed at the parent's rate. So it prevents somebody from gifting a lot of interest-bearing accounts, let's say, and then paying tax at a much lower rate than the parents would pay. So just be aware that you want to be really, really smart with whatever you're giving so that the kiddie tax provisions don't kick in and kind of defeat the purpose of perhaps some of the gifts that you were making. The annual gifts, like I mentioned, 2025 in the future, we can do that as of today, not backdating them. It removes the asset from the estate, so it removes the appreciation as well. And if for qualified tuition or medical expenses, there can be an unlimited amount. So if you have somebody that's in the hospital or maybe that's going to college and you want to make a donation as far as the gifting goes, we can do that through the medical expenses and the tuition. All right. I want to also look at some of the other issues here with some of the tax rules for 2025. And this is for required minimum distributions. This year, if you reach age 83, in this, or excuse me, 73, I can't even read my own slide here. 73 this year, you do have to take required minimum distributions. And so it can affect your taxes because that's income that you're going to have to take. It also can impact Medicare. So let's make sure that you're aware that whatever your required minimum distributions are, and they're not required for Roth plans, but for other IRAs and what have you, they are, that you don't miss any of these deadlines and have to take any of the penalties associated with that. We also want to look at some of the business tax strategies that need to be on everybody's plate here. With if you don't have a business, you need to be looking at one, right? That's where a lot of the wealth in this country is. That's where a lot of the tax deductions come into play. Same thing with rental properties. To me, one of the biggest tax advantages that any of us can really get is going to be in the rental properties because we can do this legal fiction of reducing in value via depreciation the value of a house that we're certainly banking on going up in value. So we've got an appreciating asset that for tax purposes we're depreciating. So to me, rental properties really, really make sense for a lot of investment portfolios. Now, maybe not at current interest rates. I don't know about that. And you need to do your due diligence as with any other investment, but boy, they sure do really fit in nice with an overall business tax plan. Let's get the tax plan in place now. If you don't have a tax professional, get one. And we need to be watching these rates because what if the QBI goes away? We're going to want to start seeing a lot of S corps revoking their S election, and going to C Corps. So a lot of possibilities that could come into play. My guess is in the second half of this year that we still have some time in, probably this summer sometime. Start getting maybe a little heads up on where we're going. Um, all deductions except for entertainment. Make sure that you claim any of these personal expenses that, a portion of utilities, computer, office expenses, home office, all of these can be claimed either directly or through an accountable plan, which everybody should be looking at as a way that they can get money out of their business for personal expenses that are also used for the business. So if you don't have an accountable plan, talk to your tax pro, get a coordinated tax plan so that you don't make some of the same mistakes year after year. Business meals, same rules apply as last year, 50% deduction, no real changes there. So I'm not concerned with any changes as far as any of your record keeping or what have you. Some of these are changing here as far as our business income goes. The section 179 deduction goes up a little bit. Same thing with our heavy vehicles, our 6,000-pound vehicles. I mentioned bonus depreciation going down, and it'll go away next year without a change, and then the automobile staying basically the same. So very minor changes on depreciation this year. Could be big changes though next year. We need to know when we're going to get income and when that income is going to be taxable. Oops. So going back, we need to be able to look at when these different amounts are going to be taxable. So is it going to be put into play this year in 2025 or next year? Okay, that's going to be question number one. And when I'm looking at this as taxable, I'm looking at it from a business standpoint and an individual standpoint. And obviously, they can be very interrelated because if I have, let's say I have an S corporation and it has a really good year, well, that K1 is going to be really big, and that's going to affect my individual tax rate, right? And my individual tax return. So those are definitely stuff that you need to be looking at as far as the different tax rates go for you personally. Okay, we can, even if we make the assumption here, and I am assuming this for myself at this point, that the tax brackets are going to stay the same next year. They'll be adjusted a little bit for inflation, so they'll go up a little bit, and we'll get a little bit of a break because of inflation, but not really much of a change. Now, if that turns out to be wrong, I'm going to make big changes in the fourth quarter of this year. But if it turns out that way, I need to be looking at what's my flow through business income looking like? What's my W-2 income looking like? What's my rental properties looking like? What's my C Corp looking like? Maybe I have a C Corp over here that's paying tax at 21%, and I want to get money out of that business, or I want to leave it in and have it taxed there. So a lot of things come into play, again, depending on who you are. Um, and so we want to look again at Schedule A, which is going to be our individual itemized deductions. And so if we're right around that 30,000 amount every year, maybe we want to hold off on our charity till January of next year. Or maybe we want to accelerate it and say, well, whatever I was going to give next year, I'm going to give in December of this year. And I'm going to bunch my expenses so I can get the biggest Schedule A deduction in 2025 or in 2026 because I know my income is going to go way up next year. So again, depending on who you are, there's not a one size fits all as far as do you want to delay or do you want to accelerate taking the income and expenses? Do you want to try to match them or do you want to say, look, I know my income is going to be really different next year, so let's take that into consideration this year. All right, few very last minute thoughts here. And obviously we've still got a month or so till April 15th, but as far as the taxes go here, don't just simply rely on your tax professional. And I can't stress this enough for that I prepared one of my daughter's returns and I said, we need to go through your return so that you understand exactly where every number came from. This isn't something where you say, oh, I trust your tax professional. I get it, right? If you don't trust your tax professional, why are you having them do your tax preparation or your tax planning, right? You're not going to do that. So I get that you trust your tax pro. And if you don't trust your tax pro, get a new one. Find one that you do trust. So you trust your tax pro. Guess what? We're all human. We all make mistakes. And we may make a mistake that happens to be in your favor. We may happen to make a mistake that goes against you. And so you overpay taxes. And so my daughter came back to me and she had two questions about where some numbers came from. And they were totally legitimate questions because you don't necessarily see where the numbers come from on the return. So maybe you punch in a number and then it goes to this worksheet, and then based on how you answer it, it comes over here, and then the number maybe gets added with something. And then you wonder, it's like, well, what is this number? Don't sign your return unless you're aware of all these numbers and where they're coming from. And if your return preparer can't explain it to you, find a new one. Okay, we ought to be able to at least go through the return with you and say the wages on line 7 are because of these three lines. Oh, okay, I missed that one, right? So make sure your return is correct. And if it's not, let's say that you find out afterwards that something happened, we can amend the return. Now, that's not a strategy that I advise. I mean, let's not intentionally amend our tax returns because it gives the IRS two different chances to look at the return, right? Where you just file it once, they got one chance, they're going to look at it, audit it or not, whatever, let's move on, right? Where if you're now filing an amended return, IRS may want to take a look at the original return as well. So, as far as the last minute thoughts go, don't worry about if a mistake is made. I mean, we can always fix it, but we try not to make that mistake. And if we can't get the return filed on time, for myself, I'm still waiting on K1s right now. So I'm going to have to personally extend my 1040, even though 95% of it is already done. If I end up owing, okay, if let's say that I think I'm going to owe 10,000 bucks, I'm going to pay that on April 15th, even though I'm not filing the return, because filing a tax return only extends the time to file, not to pay. And if you can't pay anything, file it anyways. Okay, I want to see you filing the return. I see people that won't file their returns for, the last couple of years because they don't have the money to pay it. And guess what? The IRS statute of limitations for them to audit those returns never starts. So file the return. If you can't pay it, file it and get a payment plan with the IRS. But don't just not file it and let the return sit there. Okay, so those are just some of the thoughts that I have as far as tax day 25 coming up in another month or so. And I'm going to leave you with this little quote on the screen, and I guess turn it back over to my good friend Don Pendleton to go through some of the Q&A and see what we have out there. So Don, I'm going to send it back to you right now.
God, you must be really tough on your daughters if they have to explain every question. I don't know that I could do that on my tax return.
Yeah, I don't make them have to do it. I just say that, if your W-2 says you made 50,000 and line 7 says 50,000, it's like, okay, that's good. I see where it came from. But if the line in the W-2 says 52,000 and it says 58,000, you're like, well, where's the 6,000? And so I think it's good that people know like where these numbers come from so that some of the tax stuff, some of the mystery of it, it's like, oh, I'm never going to figure that garbage out. It's like maybe, but you can get yourself a little more informed so that you just have some idea what's going on.
Okay, great. Okay, students, we're going to open up a new section, and that is Q&A. And a lot of you have typed in your questions, even though we kind of ask you to wait. But that's okay. We're going to start with those. And traditionally, what happens is we get more questions than we can possibly answer. And so we're going to go till the top of the hour. And then after that, I need to give Scott a huge thank you and let him go for the evening. But we're going to go through these as fast as we can. So Ken is asking, he's saying he's moving to Florida. Right now, he has a New York State corporation, an S Corp. He wants to retitle the assets. How do you do that without paying New York taxes?
Yeah, that's a hard thing when you've got, and that's something I didn't even talk about tonight, but I mean, it's certainly a legitimate question is what's the role of state taxes, right? I mean, you're in a New York state that has a very, very high rate of taxation, and that's not including those people who happen to live in New York City who also pay an additional tax there. So there's a state and a city tax for those folks, like if you're living in Manhattan or whatever. But you have to look at when you're moving the business as to where the business is really going to be located in doing business and where are the assets so that somebody that's doing business in New York and moves to Florida isn't going to be able to avoid New York tax on the business income there. But I would want to talk there with a tax professional that's really up to speed on both of those states and fortunately for you, there's a lot of tax professionals that specialize in people from New York and Florida, given the annual migrations and going
Right.
down winter and playing the I'm going to spend 6 months in one day in Florida, so I don't know I'm not a resident of New York, and there's all kinds of different things that you can look at. But I would definitely talk to an expert on those two states because the IRS isn't going to really care where your business is located. Your 1120S for the S corp, it's going to look the same.
Okay. Can a 1231 long-term capital gain incurred in 24 from the sale of real estate be offset, reduced by long-term capital loss carried forward from 23?
Yes, it can, absolutely. I thought my answer to
Yep.
that question was going to be no, because I thought the question was, I've got a capital loss this year, can I carry it back? And the answer would be no. But if you've got, say you have a $50,000 gain in 24, and if you had a $50,000 loss in 23 carry forward, meaning that you could only use 3,000 last year, and then you had to carry the rest forward, you could zero that out. So yes, you could use it in full.
If I give a donation to a qualified charity where the amount exceeds my total tax liability that year, is the surplus donation lost or is it carried forward to future years?
Well, your donation is based on your adjusted gross income, and so once it zeroes it out, then it's going to carry forward into the following. I believe it's 5 years of carry forward on charity. Don't hold me to that, but I believe that's what it is.
But it's not based on your total tax liability, it's based on your AGI.
Correct. Correct. And that's
Okay.
where the number is 60% this year. So if I have an AGI of 100,000, I could have a $60,000 charitable donation. And let's say I gave 70,000, let's say to a church, the 10,000 extra would carry forward for the next year. And like I said, I believe it carries forward for 5 years thereafter. But typically you're going to be using that, and with planning, you're going to use those carry forwards in the following year anyways.
Good. Could you explain a little bit more about the Roth conversion recharacterization? What is that?
We can't do it, so I don't really want to get into something like that. It was something before where we could put into a Roth, and if the value of the Roth went way down, we could recharacterize it, and so we would be able to change basis, and we'd be able to change contributions and everything else, and that's been eliminated. So we can't go down that road unless Congress somehow brings it back, and I don't think they will because that's a big revenue loser for the government at a time that they want to cut taxes. So I don't see that happening.
Okay. Can I do a SEP from a 1099 income when still employed while they're maxing out their 401k. Can you do both the SEP and the max out the 401k?
No, you can't. If you didn't max out the 401k, then you could do a SEP through the corporation, I guess, and go up to the maximum. But you're not allowed to have like five companies and have five companies all maxing out a SEP plan or a 401k. I mean, and it's a good thought because why not, right? I mean, unfortunately, it happens to be per taxpayer, but it would be a sweet situation if we could kind of split our buckets up that way. But unfortunately, no.
That's called creative tax planning. Yeah, and
Yeah, it's what everybody, you guys should be thinking about this. It's like, if I say, well, you can contribute whatever, 70,000 to a 401k, you all should be thinking, wow, that's really cool. Can I contribute 140,000 if I have two? Right? I mean, that's not a bad question. To me, that's a smart question because maybe the
right.
answer is yes, or maybe there's another way we can do it, or, you just don't know unless you ask those questions.
Okay. Lisa is saying tuition in college is only for your own schooling, not for children, right?
No, that's not right on
No.
there. You can do that for your dependents.
Right.
Um, Child independent care credit. The downside with the college credits is that there's phase outs on them. And I don't remember what the range is, but if you make more than, whatever, if you make more than 100,000 but less than 200,000, you may not get the whole thing, and make more than 200, you don't get any of it. I don't remember what those numbers are, but there are phase out amounts for sure.
But I took deductions for every one of my kids when they were going through college, and there's
Yeah,
tax. You know, you
yeah, yeah,
use those.
no
Yeah,
doubt, and it depends on the year. For say somebody in your position, Don, or like in my position where I had 8 or 9 years of college, you had whatever it was. Those laws could be changing every other year. So one year I might get the deduction, one year I might get a credit, next year I might make too much money. So these all change every year, but always be looking at that from your perspective and any dependents on any of the credits.
okay. If somebody has 1099 NEC income, can they take the home office deduction?
Yes, they can. 1099 NEC just means NEC, non-employee compensation. And so it just means they have a business in effect.
Right.
And so there you have to look at how's the business structured, right? And if it's structured as a single member LLC or a sole proprietorship, you could take the home office. If it's structured some other way, you would probably take it through an accountable plan. But yes, either way, if you've got a home office dedicated for business use, absolutely, you can claim the deduction.
And I've seen Toby's slides for next week, and he's going to spend a lot of time on explaining the accountable plan and why that's really so important. And so, to,
That's
he'll be
that's
speaking on
really
Wednesday. Make sure you're paying attention during that time.
yeah.
Okay.
I mean, I learn a lot on the 3 days just from all the speakers since I'm not constantly looking at real estate. But one of Toby's big things, and I mean, he's been pounding into me for years is the accountable plan, just get it set up. And then we don't have to worry about like when there was we had discussions about cell phones when we didn't know how you could deduct them. And we don't have that anymore. But an accountable plan is just a way to get some of these personal expenses that are used for business reimbursed.
Cool.
Yeah.
Okay. Can you have both the SEP IRA and a traditional plan for your business with you and your employee?
Yes, yes, you can. And I mean, one thing you can't do is discriminate, though. So it says if it's my business and Don's my employee, whatever I do for myself, I've got to cover Don as well. So there's no discrimination rules there, but yep, you can certainly do that.
So I have both a SEP and a traditional. Well, I'm sorry, and a Roth. So the SEP is a traditional, You can't do the can you do the SEP Roth? I don't think so.
No, you can do the
Yeah,
401k Roth, and that's normally
right.
what we see on people that are earning a little bit less money today because the value of the deduction, maybe let's say your tax bracket's 22%, we just forego the deduction, on the whatever you put into the Roth, and then I never pay tax on it again. I mean, it's like the perfect investment vehicle for somebody that's young and not making a lot of money. And I think the older you get, with the more money that you're making, then it becomes more of a math problem of, do I want to take the deduction today or do I want to, forego it and, kind of look at it that way, both ways.
So I was down in Arizona last week, Scott, and talking to some real estate people, and I created some slides just for them, saying this investment might be really good in a Roth. This might really be good in a traditional. This might be good in an LLC, but we wouldn't do that. And so there's a difference. And so sometimes your tax professional needs to know what it is you're doing. The Roth is not for everything. You lose the depreciation deductions. You lose the cost segregation. There's things you don't want to do in an IRA, but certainly we could. Okay, is there a simple Roth IRA available? At Todd asks. Simple Roth IRA.
Man, I believe there is, but I'm drawing a blank on that right now. The simple IRAs are really nice because you can zero out the income up to whatever it is, the 16,000 or whatever that you can contribute to the simple. Um, but I'm just drawing a blank. I'm not sure.
SEP IRA, SEP Roth, no. Simple, but you could contribute to the SEP or the simple and then convert it to a Roth later, couldn't you?
Hmm. Hmm.
Yeah,
Yeah,
pay the
you could do
taxes
that. I'm
on
just
it.
thinking about the simple Roth. Like, is there that type of a plan? And I'm just not coming up with it right now to know whether there is or isn't. I've never seen it.
Yeah, I don't know that one either. There's a lot of people named anonymous on the call today, or one person with lots of questions. Okay, how,
There you
how
go.
can
There
we
you
get the
go.
recording or the slides? I missed the first part. Okay, so anyone who registered for this event, and you're on the call, so obviously you registered. Kendall will send that out tomorrow, and it probably won't come from us. It will probably come from Zoom. But it'll be or YouTube. I don't know, but the recording will come out tomorrow. And if not, it'll be available on our YouTube channel probably tomorrow afternoon. It takes us a little while to take it, but the recording of this, yes, we are recording. And okay, another question. I have a single owner, no employee LLC, so single member LLC, pass through, so it's disregarded. I'm assuming. I thought New York self-employment would be reduced to itemized deductions, the reduced income significantly. It did not. I still owe money. Ugh. I
Right.
wondered if I can move some of my Schedule A itemized deductions charitable that make sense to a Schedule C to reduce my tax on self employment of my amended return. So, single member
Yeah.
LLC disregarded. Can she move personal to business?
Boy, it'd be nice to be able to do that, wouldn't it? And something like this. So yeah, unfortunately, this person that asked the question is stuck here because they have a Schedule C business that every dollar that is a net profit gets taxed at that 15.3% rate. And that's why, from a tax perspective, we really don't like, we're fine with single member LLCs. We're fine if they're disregarded, but we really like them to be disregarded into an S Corp or something where we're not going to get hit with the SE tax. But here, you can't you cannot move the charitable donations from the personal to the business. So that we're kind of stuck there. What you may want to look at is maybe you have some sort of a home office, some sort of accountable plans. Have you missed any expenses, cell phone, automobile, mileage, meals, any of that sort of stuff, insurance? Um,
Internet.
Yeah, any of that stuff, rent, whatever. And if you've missed it, great, take the deduction. But if you haven't, make sure, actually, you've still got time this year. You've got till March 15th of this year to take an old entity and convert it to an S corp. So that might be something for tax purposes that you would look at here. Again, I
Even
can't.
retroactive. Take your
Yeah, yeah, you
your
can make it retroactive for the first couple months of this year. It won't go retroactive to last, but
right.
it'll be retroactive to this year. But again, this is one situation where that's a thought that popped into my head, but it may not be appropriate for you. So you got to make sure it's the right thing for you, but you've got 4 days to do it if you want to make it effective for 2025.
Yeah, great. On a 1031 exchange in 2024, is the accumulated depreciation recapture taxed in 2024, or is the adjusted basis on the asset rolled to the basis of the new asset acquired?
When we're talking about 1031 exchanges, so the year of the sale, which would be the year of the exchange, was 2024. So
Right.
any of the accumulated depreciation would be typically carried into the new asset. So that would be usually one or more rental properties, commercial, residential, whatever it is, and the basis with the accumulated depreciation carries into the new properties. And the only thing that you would adjust it by here would be if you had to put money into the transaction, and then that would be considered an additional capital, so you'd raise your basis then. But otherwise, the basis of the asset should transfer to the new assets, but you don't have to like recapture it all in 2024.
Okay. Mohammed is asking, can I categorize contributions to my child's 529 plan as a gift?
Yeah, you certainly could. Usually when you're looking at the 529 plans, though, considering they're used for education, we don't have to really worry about that. So that's something that we can put in, whatever the limits are for the particular plan. So we wouldn't be necessarily limited to what the gift tax, the 18,000 last year, 19,000 this year would hold us to. So you could put more than 19,000 into a 529 plan.
Yeah, and there's catch up contributions with that, and especially for grandparents.
Yep.
But I don't see the benefit of categorizing because you're getting not a federal tax deduction, but a state tax deduction for the 529 plan. But I don't see the benefit of treating it as a gift. Is
No,
there?
I don't think there would, Don. I mean, certainly there's I think 30 some states, close to 40 now, that give you a tax deduction like Utah does or like Colorado does on the state level for any contributions. But you wouldn't have to do that through a gift. So it could go from Scott's account to the 529 plan set up for the benefit of child number one, and that wouldn't even mess with the gift at all. I could still give, some more money if I wanted to my child at that point.
Right. But don't expect to get rich off these state tax deductions.
No,
It's
no,
it's
it's
not
something
a
where
big deal.
no, but the states, I mean, everybody wants to encourage, education or whatever. We want to try to make it as easy as possible. Um, but, don't expect it to pay for a whole lot.
Okay, Daniel's asking if I have multiple IRA accounts, do I take an RMD on each account or just one as the withdrawal is big enough?
You have to put them all together, and then whatever that amount is cumulatively, that becomes the amount that you have to take. Now, what account you take that from, it would be up to you. So if you put them all together in your accounts and you've got a couple $1 million or something, and it says you got to take 50,000 out, you've got to take it out, but you could take it out of your Vanguard account or out of some other self-directed account or what have you.
But not each account.
But yeah, no, you don't
Okay.
have to take them out of each account there. And if I could just say one other thing here, I did just like look this up just really quick here, and you can do a Roth simple IRA. I've never done one, but you can do it. So to answer our question from, I don't know, about 8 minutes ago or something, yes, you can do it.
And Scott, we have a lot more questions than we started with. We're going the wrong
Yeah.
direction here.
Why does it always happen with taxes that the questions keep going like that? We're down to our 6 minute warning and we've got more that we can do, but let's
The
bang out
tax
a few
questions
more.
are like little tribbles. They just keep growing and growing. Okay.
But yeah,
Can I
because people are
transfer
thinking.
7,000 from my 529 plan to my son's Roth IRA if I set up a 529 plan in 1995 but transferred 529 to another institution? I
You've got
I,
no,
I don't know
you
on that,
you got
Devin.
to use there's specific rules for 529 plans and what they can be used for, as far as education expenses go, or sometimes they can be, if you have two kids, you can take the one kid that's not going to go to college and give it all to the second kid. So there's lots of different things you can do, but you can't do anything you want with it because the 529 plans are set up specifically for college. So you've got to go to the custodian of the plan, whoever that is. It's typically for 529 plans, it's like Schwab or Vanguard or somebody, and find out what the rules are for that plan because they all are a little bit different in what they do and what they can do and investment vehicles, that sort of thing.
Okay. 78 years old, inheriting 400,000 soon. Can I put this money in my current Roth account and grow without taxes? No, you'd still have a contribution limit.
Correct. Yeah. So if you have earned income, you can still put the money into the Roth, but you'd be limited to whatever, $7,000, $8,000 a year. So no, that's not gonna really help you on that front there, on the inheritance portion of it. The good news is that the amount that you inherited, is not gonna be taxable to you. So you're starting off at least with that, but any investments that where you make money on that, what was it, 400,000 or whatever, that becomes taxable. So, if you make 20,000, you got to pay tax on 20,000.
Okay. I recently learned about tribal tax credits. Is this legitimate?
I would be very, very worried about that unless you were part of a particular, if you lived in one of the native communities. But if it's something to get you to invest in sort of a tribe, quote unquote, be very worried about that. And I would certainly look it up. IRS.gov has a lot of stuff. It's like I love to criticize the IRS, but their website is really good, has a lot of information there, and you can find out if there's a tax scam going on with maybe tribal credits, or maybe it's totally legit. But before you invest anything or give them any money, make sure that you get the answer sort of in black and white. Don't take it from the internet.
And I've talked to several people this year already on constitutional easements. Well, that's right at the very top of the dirty dozen taxes, the
Yeah,
IRS things that they're looking for.
yeah, when you see constitutional and you see tax in the same thing, it's probably not legit. So I'm going to do a constitutional trust to save on taxes. It's like, no, well, you may be doing that and you may save on taxes, but it's not going to be legal.
Yeah. Okay. Oh, we got a couple more minutes. Lisa, okay, this is a follow up question about kids. What are the tuition benefits, the tax benefits for kids going to college? They're,
Well, I don't know. I mean, as far as what can you use the money for? You can certainly use it for tuition, room and board, but you can use it for electronics, so laptops, tablets, phones, that sort of thing. It's pretty broad as long as you can attach education to it, that these expenses are being used, buying books for the community college that I'm attending classes at. So it doesn't have to be, going to some big 4 year school or whatever. It can be a lot of different ways that you can utilize that money tax free, right? Because when you pull it out, you don't have to pay tax on it when it's used for education.
But Lisa, if you've got kids or if either even yourself, tuition can be tax deductible. So can housing. So can books and computers and anything. Well, not
Hmm.
anything, but yeah, those. What's the tax benefits? The expenses is tax deductible is the benefit.
Well, yeah, or if you're looking at it from a 529 plan perspective, I put 10 grand into my 529, and 18 years later, my little baby here is now going to college, and that 10 grand is now worth 50 grand, right? And so I've got this $40,000 gain, but if I use that 50 grand to pay for my daughter's college, that $40,000 gain gets wiped out. And so that's really the real benefit to the 529 plans is we can make these contributions. It makes this money tax deferred, and it becomes tax free if I use it for education. Just like the HSA, the health savings account, becomes tax free if those funds are used for medical. It's kind of the same principle there, and you have a pretty broad definition of what's medical or what's education, so that we can use those expenses typically for somebody in the family.
Okay. Swen is asking if one's an active trader, futures, forex, options, stocks, placing trades in your own IRA is not receiving any financial benefit. So is that considered a prohibited transaction?
No, you
If you're
can
doing your
you
own
can
trading in your IRA, is that prohibited?
No, you can do that. I mean, as long, prohibited transaction means that you're getting a personal benefit from it today. So I've got
Right.
a rental property in my IRA, and then I go stay in it for a couple weeks, right? I mean, something where I'm getting a personal benefit. You can day trade, minute trade, if you want to trade by whatever in Forex or whatever your platform happens to be as far as what you're trading. You can day trade in that all you want. That's not going to be a problem as well. And when you say you qualify as a trader, that gives you tax benefits not inside the IRA, but outside the IRA, really. Whereas now you've got a lot of the things that you've got mark to market election, you've got different things where you're not limited on your capital losses to $3,000. You've got a lot of benefits as a trader if you can qualify as one.
Right, and so I've seen I've seen Clint's slides for next week. I have some inside information here. I know what he's going to be talking about, and he's going to be covering this, and maybe the benefits of setting up a corporation to manage your trades and take the tax benefits, but not to manage your IRAs. So we can't do that. That would be a prohibited transaction, is to
Yeah.
take a management fee and send it up to your corporation out of the IRAs. But there's a lot of benefits for this. And Scott, I appreciate you taking time. We're a little bit over what I promised you. Students, Toby's not really a partner, but you've worked with him for 25 years, haven't you?
Yeah, actually, I've worked with him since '01, so 20, yeah,
Wow.
24 years. But Toby and I have been, we put together a really cool tax program, and I was in Vegas a couple weeks ago with him, doing a lot of recording on some of the stuff we talked about tonight, and going to go back there as soon as Congress gets its act together and tells us what the law is and what it's going to be. I'll go back there and record, but no, we've been going at the same type of game for a long, long time here. And I think it's really important that the people get the education one way or the other, for it. And that's why I've always liked the 3 days because, somebody like Clint can come in and talk about asset protection where it has a tax component, or somebody else will talk about, the investment strategies or the tax planning and kind of to put it all together, for each of us who, like I mentioned before, we're all unique in this. And maybe a corporation and an LLC for me is really good, but it'd be a bad structure for Don, for whatever
Right.
reason. So we always want to look at the individualized portion of it and making sure whatever's done makes sense for you, as an individual or as a business owner.
Every speaker at the 3-day summit will be talking taxes in some way, whether it's Clint or Toby specifically on taxes, or whether it's Troy Eckert, or whether it's Aaron Adams, or Mike Koval. We're all going to be talking taxes. I'm going to talk case studies and pull in everything. Here's when we might use an S corp as opposed to a C corp, and we have a sole proprietorship over here so that we can pay our kids without them paying self-employment taxes. Everything we do is going to be tied to taxes of some kind. If you haven't enrolled, please do that. Scott, thank you so much for your time. I wish we still have more questions than we started with, but Scott, thanks for taking time. And I'm going to close with Lisa's comment saying Scott is the best. Good for you, Scott. Thank you. For all of you, thank you for being on. There's so many places you could be, especially right now. We appreciate you being here. Thank you very much. Have a great night. Thank you for the heart. Have a great night. We'll see you.